Continue to dive into the first thing you need to know today. Investors will be listening closely to Fed Chair Powell's remarks around 12:40 Eastern Time and searching for clues on what the new economic narrative will be after Friday's blockbuster jobs report. To paint the picture, let's bring in Advisors Capital Management Partner and Portfolio Manager JoAnne Feeney. JoAnne, good to see you as always. Within the past 24 hours, I would argue we have gotten hawkish comments from Raphael Bostic and this morning from Anil Kashkari, really pushing back, I think, on the market narrative that we're getting a Fed pivot. How should investors trade that?
Yeah, good morning, Brian. I think investors need to recognize that the Fed is fully committed to getting inflation under control and that there's a lot more work to be done. Clearly inflation has come off of its peak, but the labor market remains tight. Wage growth remains above a level that's consistent with a 2% inflation target. But on the other hand, we do have pretty strong consumer numbers out there, which is sustaining a pretty healthy economy in the midst of all this.
How long do you believe that the consumer numbers that we're continuing to take a look at and parse through can sustain?
Yeah, Brad, it's a bit hard to tell because, we just don't know how things are going to play out over the next year. We're certainly seeing some parts of the economy contract, notably in the tech sector and in those areas which really benefited from the pandemic. On the other hand, when you look at the number of employed people that has risen so substantially, over the last couple of years, what we're seeing is disposable income in aggregate, adjusted for inflation, has actually been rising for the last several months, even though wages aren't keeping up with inflation on sort of a household person-by-person basis. When you aggregate all of the new people that have jobs and those wage increases, you actually see real disposable income going up. And that sustains a pretty strong demand from the consumer. Even as things are slowing, we're still seeing that kind of resilience, which is encouraging.
Encouraging, I guess, unless you're worried about the Fed seeing that and raising rates even more, right? I mean, Raphael Bostic, in an interview with Bloomberg, saying that given the strong jobs report, the Fed is going to need to keep going. Is that sort of a precursor of what we're going to hear from Jay Powell today? And is that going to then discourage the markets?
Yeah, Julie, I think we can count on that. The Fed has been really clear that it sees a need to continue to raise rates and to keep rates high for a sustained period of time until they have convincing evidence from their data, from their work, ground level work, that inflation is going to continue to come down and reach that 2% target. So I think investors might be a little bit premature in seeing an end or a beginning of rate cuts. I think that is not in the cards for this year. And so they are probably going to get sort of a hawkish, as they say, set of comments from Jay Powell today when he speaks. And that might, douse a little bit of this enthusiasm for, the run-up in stocks we've seen so far this year.
And JoAnne, since we got those comments, those disinflation comments from Jerome Powell, we've seen some nice trades in the tech sector. How are you trading that sector right now if we do, in fact, get that pushback from Powell later today?
Well, Brian, the thing about the investing in the tech sector is one had really better be long-term focused, right? When you own a tech stock, whether it's a Microsoft, an AMD, an NVIDIA, a Broadcom, you're really not looking at just what's going to happen this year. You better not be. You're looking at what's going to be delivered from these companies in earnings and cash flow over the next several years. And I think the run-up we've seen in the beginning of the year is a reflection of the fact that investors are becoming more willing to accept that the first half of this year is going to be tough. We're seeing declines in earnings year over year, and that's going to continue probably for a couple of quarters. But I think investors are now looking to the back half of this year, and more importantly, even to 2024, where they recognize that these long-term growth drivers, whether it's more 5G, whether it's more data center activity, whether it's more Chat GPT or now Bard coming out of Google, this creates demand for the chips that NVIDIA and AMD provides, for the software and the cybersecurity software that Palo Alto provides. And investors want to make sure they own these companies that are really going to be able to drive growth in their portfolios at a much higher rate than some of the consumer staples. And they want to rotate out of those safer things that they were in last year and make sure they're positioned for long-term growth for the next few years.
We've seen a little bit of a tech bounce to start, or at least a bear market rally for tech to start this year in 2023. Do you believe that valuations are at enough of an appetizing level?
Yeah, Brad, broadly speaking, valuations for the S&P 500 as a whole are not particularly attractive, right? The market's trading at 18 or 19 times. And in a situation where interest rates and inflation are as high as they are, even though they're going to come down, that's not a particularly cheap market. And so you really have to pick and choose and compare where is the stock trading on a PE level, forward-looking PE, relative to what kind of growth they can deliver? You look at a company like a Microsoft trading at like 25 times, or an AMD, and if they're able, that's a little bit higher than the market, but they're able to deliver growth that's multiples higher than the market. And so that's how you sort of have to think about whether the valuations are justified.
Advisors Capital Management Partner and Portfolio Manager JoAnne Feeney, thank you so much for joining us. Always appreciate your insights and your time.